Mastering Money, Save and Invest Like a Pro. Today we're diving into the best ways to save and invest your money, helping you to build a solid foundation for your financial journey. Let's dive in. Budgeting. It's a term that often evokes a sense of dread, but it doesn't have to be that way. In fact, budgeting can be empowering and liberating when done correctly. The foundation of any good financial plan starts with budgeting. It's the cornerstone that supports all your financial decisions and goals. Without a budget, you're essentially navigating your financial life without a map. Without a clear understanding of where your money is going, it's nearly impossible to make meaningful progress. Many people find themselves stressed and overwhelmed by their finances simply because they lack this crucial insight. Think of your budget as a roadmap for your finances. Just as a map guides you to your destination, a budget helps you reach your financial goals. It shows you where you are, where you want to go, and the best path to get there. To create an effective budget, start by tracking all of your income and expenses for a month. This will give you a clear picture of your financial situation. Use tools like spreadsheets or budgeting apps to make this process easier and more accurate. Categorize your expenses into needs and wants. This distinction is crucial for understanding your spending habits and making informed decisions about where to cut back if necessary. Needs are essential items like rent, groceries, and utilities, while wants are non-essential items like dining out or entertainment. By clearly identifying these categories, you can prioritize your spending and ensure that your essential needs are always met. The goal is to ensure that your income exceeds your expenses, leaving you with a surplus that you can allocate towards saving and investing. This surplus is what will help you build wealth and achieve your financial goals over time. Set financial goals, both short-term and long-term. Short-term goals might include building an emergency fund or paying off a credit card, while long-term goals could be saving for retirement or buying a home. Allocate your surplus income towards these goals and adjust your budget as needed to stay on track. Flexibility is key. Your financial situation and goals may change, and your budget should adapt accordingly. Review your budget regularly, at least once a month, and make necessary adjustments. This regular review helps you stay accountable and ensures that you are making progress towards your financial goals. One effective method is the 50-30-20 rule. 50% to needs, 30% to wants, and 20% to savings and investments. This simple formula can help you maintain a balanced budget and ensure that you are saving enough for the future. Consider using budgeting apps like Mint or YNAB. You need a budget to simplify the process. These apps can help you track your spending, set goals, and stay on top of your finances with minimal effort. By leveraging technology, you can make budgeting a seamless part of your daily routine. Emergency fund. An emergency fund is an essential component of a solid financial plan. Life is unpredictable, and having a financial safety net can provide peace of mind and protect you from unexpected expenses. Start by setting a target amount for your emergency fund, typically 3 to 6 months worth of living expenses. To build your emergency fund, set up a separate savings account specifically for this purpose. Automate your savings by setting up automatic transfers from your checking account to your emergency fund. Define what constitutes an emergency to avoid unnecessary withdrawals. Regularly review and adjust your target amount to ensure it aligns with your current needs and circumstances. By having a well-funded emergency fund, you can handle unexpected expenses without derailing your financial progress or going into debt. Savings accounts. Choosing the right type of savings account can make a significant difference in how quickly your money grows. It's essential to understand the various options available to you and how they align with your financial goals. Each type of savings account comes with its own set of features, benefits, and limitations. By carefully evaluating these factors, you can make an informed decision that best suits your needs. A basic savings account is a great starting point, but typically offers low interest rates. These accounts are ideal for those who are just beginning to save or who need easy access to their funds. They are often linked to your checking account, making transfers simple and convenient. However, the interest earned is usually minimal, so it's not the best option for long-term growth. High-yield savings accounts offer higher interest rates and are usually offered by online banks. These accounts can significantly boost your savings over time due to the higher interest rates. They are a great option for those who want to earn more on their savings without taking on additional risk. However, they may come with certain restrictions, such as limited withdrawals or higher minimum balance requirements. Money market accounts offer higher interest rates and check writing privileges, but may require a higher minimum balance. These accounts combine features of both savings and checking accounts. providing flexibility and higher returns. They are suitable for those who maintain a higher balance and want the ability to write checks or use a debit card. However, the higher minimum balance can be a barrier for some savers. Certificates of deposit, CDs, offer higher interest rates in exchange for locking your money away for a fixed period. CDs are a good choice for those who do not need immediate access to their funds and want a guaranteed return. The interest rates are typically higher than regular savings accounts, but the trade-off is that your money is not accessible until the CD matures. Early withdrawal can result in penalties. Consider using a combination of these accounts to maximize your savings. Diversifying your savings strategy can help you take advantage of the benefits each type of account offers. For example, you might use a high-yield savings account for your emergency fund, a money market account for medium-term goals, and CDs for long-term savings. This approach can provide a balance of accessibility, higher returns, and security. Pay attention to interest rates, fees, and minimum balance requirements when choosing a savings account. These factors can significantly impact your overall returns and the convenience of managing your account. Some accounts may offer attractive interest rates, but come with high fees or stringent balance requirements. It's important to read the fine print and understand all the terms and conditions before making a decision. Take advantage of employer-sponsored savings programs like a 401k plan or health savings account, HSA, for additional benefits. These programs often come with tax advantages and employer contributions, which can significantly boost your savings. A 401k plan is ideal for retirement savings, while an HSA can help you save for medical expenses. By leveraging these programs, you can enhance your overall financial well-being and achieve your savings goals more effectively. Basics of investing. Investing is a powerful tool for building wealth and achieving your long-term financial goals. By putting your money to work, you can potentially earn returns that outpace inflation and help you reach milestones like buying a home, funding education, or enjoying a comfortable retirement. The key is to start early and stay consistent. The first step in investing is understanding your risk tolerance. This means knowing how much risk you are willing and able to take on. Risk tolerance varies from person to person and can be influenced by factors such as age, financial situation, and investment goals. Assessing your risk tolerance helps you choose investments that align with your comfort level and financial objectives. One of the most common investment options is stocks, which have the potential for high returns but also come with higher risk. Stocks represent ownership in a company, and their value can fluctuate based on the company's performance and market conditions. While stocks can offer significant growth, they can also be volatile, so it's important to be prepared for ups and downs. Diversify your stock investments to reduce risk. Diversification involves spreading your investments across different sectors, industries, and geographic regions to minimize the impact of any single investment's poor performance. By holding a variety of stocks, you can potentially achieve more stable returns over time. Bonds are generally considered lower risk investments compared to stocks, but offer lower returns. Bonds are essentially loans you give to governments or corporations in exchange for periodic interest payments and the return of the bond's face value at maturity. They can provide a steady income stream and help balance the risk in your investment portfolio. Mutual funds and exchange-traded funds, ETFs, offer diversification and professional management. These funds pool money from many investors to buy a diversified portfolio of stocks, bonds, or other assets. Mutual funds are actively managed by professional fund managers, while IRA ETFs cash ETFs typically track an index and are traded on stock exchanges like individual stocks. Real estate can provide rental income and potential appreciation in property value, but requires significant capital. Investing in real estate involves purchasing property to generate rental income or to sell at a higher price in the future. While real estate can be a lucrative investment, it also comes with responsibilities such as property management and maintenance. To get started with investing, open a brokerage account. A brokerage account allows you to buy and sell a variety of investments, including stocks, bonds, mutual funds, and ETFs. Many brokerage firms offer online platforms with tools and resources to help you make informed investment decisions. Choose a brokerage that fits your needs and offers low fees and good customer service. Start with a small amount and gradually increase your investments as you become more comfortable. Investing doesn't require a large sum of money to begin. By starting small, you can learn the ropes and build confidence over time. As you gain experience and your financial situation improves, you can increase your investment contributions to grow your portfolio. Investing is a long-term game. Stay patient and avoid making impulsive decisions based on short-term market fluctuations. The stock market can be unpredictable in the short term, but historically, it has trended upward over the long term. By staying focused on your long-term goals and maintaining a disciplined approach, you can ride out market volatility and achieve your financial objectives. Regularly review your investment portfolio and make adjustments as needed. Periodic reviews help ensure that your investments remain aligned with your goals and risk tolerance. Life changes such as a new job, marriage, or retirement may require you to adjust your investment strategy. Stay informed about market trends and seek professional advice if needed. Remember, investing allows your money to grow at a much faster rate than saving alone. While saving is important for short-term goals and emergencies, investing is essential for building wealth over the long term. By harnessing the power of compound interest and market growth, you can achieve financial security and enjoy the benefits of your hard-earned money. Consistency. Consistency is the key to achieving financial success. Automate your finances to ensure consistent saving and investing. Create a routine for reviewing and updating your financial plan. Stay focused on your financial goals and avoid lifestyle inflation. Surround yourself with like-minded individuals who share your financial values and goals. Celebrate your progress along the way to reinforce positive behaviors. Be patient. Building wealth takes time and there will be ups and downs. Stay committed to your financial plan and don't get discouraged by setbacks. Consistency and persistence are the keys to long-term financial success. By staying disciplined and consistent, you'll achieve long-term financial stability. Remember, the journey to financial success is a marathon, not a sprint. Take action and transform your financial future. Start implementing these tips today and watch your financial future transform. Thank you for watching. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more financial tips and tricks. Until next time, stay focused, stay disciplined, and keep working towards your financial goals.